In March 2008, Bear Stearns collapsed in 36 hours. No one saw it coming, except the people who'd already bet it would happen. The official story is simple. Subprime mortgages blew up, banks held the toxic assets, and the whole system froze. It's almost entirely wrong. Not because mortgages didn't matter, they did, but because the real engine of the collapse was something far more abstract and far more dangerous, a financial instrument that let you profit from catastrophe without ever owning the underlying risk. That instrument was the credit default swap, and it fundamentally rewrote how financial risk actually worked. A credit default swap is on paper insurance. You own a bond, say, issued by Bear Stearns. You're worried it might default, so you pay someone a fee, and if the bond defaults, they pay you back. Sounds rational, sounds like risk management. And for decades, that's exactly what it was. The first CDS was written in the 1990s. By 2007, the market was worth roughly $62 trillion notional. That number should have alarmed everyone. It didn't. Here's why it didn't. CDS weren't just insurance. They became speculation. You didn't need to own the bond to buy the swap. You could bet on someone else's default. You could even bet on the default of an entity you'd never met, had no stake in, and actively wanted to fail. Suddenly, financial risk became decoupled from actual ownership. You could profit enormously from a stranger's ruin. That changed everything. By the mid-2000s, major banks weren't just holding mortgages. They were selling CDS on mortgage-backed securities. They were betting that the mortgages would fail, and they were selling those same mortgages to other investors. They had every incentive to make sure those mortgages would default, because they'd make more money from the swap payoff than from the interest payments. This wasn't an accident. It was a feedback loop. A few people saw it. The academic Nassim Taleb warned about tail risk. The investor Michael Burry began buying CDS on mortgage bonds in 2005, betting they'd collapse. He was right, but he was early, and early looks the same as wrong for years. Most institutional investors dismissed the warnings. The rating agencies gave mortgage securities AAA ratings. The Federal Reserve saw no systemic risk. The official story held: markets are efficient. Risk is priced correctly. Everyone has skin in the game. But the system was hollow. Bear Stearns was a major dealer in CDS. It was massively short mortgage bonds, meaning it had sold protection on billions in securities that were rapidly declining in value. By early 2008, counterparties realized the firm couldn't cover its obligations. The moment that became clear, the system froze. No one would trade with Bear. No one would lend to it. In 36 hours, it went from a major investment bank to a fire sale. The real story isn't that mortgages failed. They did, but mortgages fail all the time. The story is that CDS had created a hidden leverage machine. Every dollar of mortgage risk had been sliced, repackaged, and sold as protection dozens of times over. When the underlying assets declined, the entire structure imploded because it was built on the assumption that default was impossible, or at least that it wouldn't happen everywhere simultaneously. Who predicted this? Not the regulators, not the rating agencies, not most economists. The people who predicted it were the ones positioned to profit from it, and they kept quiet. They bought CDS protection. They shorted mortgage bonds. They positioned their portfolios for exactly the scenario everyone else insisted was impossible. They didn't cause the collapse, but they understood the system's fragility better than anyone. The collapse itself was predictable, not in timing, that's always uncertain, but in structure. The system had created a scenario where massive profits could be made from default, where the people selling risk didn't own the risk, and where leverage was hidden in plain sight. Those are the preconditions for catastrophe. They're not random. They're the inevitable result of rules that were written to allow it. After 2008, regulators imposed some restrictions on CDS. Clearinghouses were created, transparency requirements were added, but the fundamental instrument remained. You can still bet on someone else's default without owning the underlying asset. You can still profit from catastrophe. The rules were bent slightly, not rewritten. The machine is still there. This is how financial systems evolve. An instrument that seems rational, insurance on a bond, becomes a weapon for speculation. Rules that seem adequate become loopholes. The people who understand the system exploit it quietly until the structure collapses. Then regulations are written, often by the same people who profited from the collapse. Then the cycle begins again with a new instrument, a new vulnerability, a new hidden leverage machine. Bear Stearns didn't fail because of a random shock. It failed because the system had been engineered to concentrate risk while distributing the profits. And the people who understood that engineering best positioned themselves to survive it. They didn't break the rules. They understood them well enough to operate within them and extract value from the system's inevitable breaking point. That's the ghost of Bear Stearns, not a cautionary tale about greed or recklessness, though those existed, but a case study in how financial rules are written, who writes them, and how they are exploited. The instrument itself was legal. The strategy was legal. The collapse was the predictable output of a legal system that allowed catastrophic risk to be hidden and profited from simultaneously. Understanding this isn't about condemning finance. It's It's about recognizing how systems work. Rules create incentives. Incentives create behaviors. And behaviors, when repeated across a massive interconnected system, produce predictable outcomes. The 2008 collapse wasn't a failure of prediction. It was a failure of will, the will to impose rules that would actually constrain the behavior the system was designed to enable. Today, similar structures exist in different forms. Credit derivatives are more regulated but still traded. Leverage is measured differently but still present. The incentive to profit from others' failure hasn't disappeared, it's evolved. The next collapse will have a different name, a different instrument, a different set of institutions at the center. But the underlying pattern will be the same: rules that allow hidden leverage, profits disconnected from ownership, and a system that rewards those who understand its fragility most. The people who understand this pattern don't need to be warned. They're already positioning themselves. The question for everyone else is whether the rules will continue to allow it, or whether the will exists to actually change them. That's not a question about finance. It's a question about power: who has it, who benefits from the current rules, and who has the authority to rewrite them. Bear Stearns is gone, but the ghost remains, not as a haunting, but as a template. A perfect case study in how a legal system can be exploited, how risk can be hidden, and how those who understand the machinery best profit from its inevitable failure. That template has never been destroyed. It's been refined. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to keep watching how the ultra-wealthy navigate the rules others follow. There's a new structural vulnerability exposed every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.